in what is both appropriate for the year we've had in 2020, as well as the theme of this week's commentary, which is it never feels right. We're having to mix it up, come to you via a Zoom to close out the last commentary of 2020. So as I said in the intro, we're having to mix it up. I swear this is not staged. I've been snowed in at my house, although it is so appropriate for 2020 that the unexpected happens. We're having to roll with it. And of course, in this case, do so within a Zoom theme, the word that has come dominate so much of 2020. So I've got Matt, who's going to join in with some of his thoughts in the Zoom-based type call. The theme of this week's commentary, again, very appropriate, was it never feels right. This certainly doesn't feel right. Usually Matt and I are hanging out in my office as we shoot these commentaries. But I want to touch on two themes real quick that I know are on the minds of so many investors, really always, but particularly given what's going on in the markets right now. The first is really thinking about risk and volatility. People are always wondering when the next shoe is going to drop. Maybe it's the vaccine rollouts. Maybe it's what's going to happen in Georgia in a couple weeks. The truth is there's always something to be afraid of as an investor, and yet the other truth is the market perseveres through it. 2020 couldn't be a better microcosm or example of that very, very thing. The second one is buying all-time highs, and we're going to delve into that in depth next week on a great piece that I came across. But really, again, it plays into that fear. It's yet another thing to worry about. Or am I going to make a foolish decision? Is now the time to get out? And that those market timing tendencies that really pull on any of us all the time. So let's start with risk versus volatility. I want to make sure to include my colleague guest here, Matt. Matt, what's your quick take? What is risk and what is volatility as you understand them?
Oh man, I'm so glad I've been listening when we shoot these commentaries because I think I got this, but we'll see. So risk is permanent loss. It's not coming back. That money is gone. Volatility is that daily reoccurring account balance up and down. There's an emotional tax to be paid there when you see your money becoming smaller, and then of course the roller coaster ride up when it gets bigger is a little bit more fun.
Got it. Perfect. Yeah. So risk, permanent loss of capital, volatility, temporary fluctuation in value, and it's so critical. It's obvious when people say it, but when you're feeling that pull of the market as it's dropping day after day after day, think March, think '08, keeping those two things separate is very, very difficult. But it's critically important for today's investors for a very big reason, which is, while I believe the risks of being an investor are always pretty much the same, your experience, the volatility is probably likely to be a lot different than, let's say, your parents' portfolio. And what I mean by that is, with interest rates at 1-2% for high quality bonds as opposed to the 6 or 7 that your parents got to have, you're just going to have a different experience from a volatility perspective. But it's critically important, and we've been stressing to so many clients, to understand, one, the distinction, and two, that avoiding risk, that permanent impairment of capital or purchasing power, because remember, you always have inflation trying to chase you down at 2%, is going to mean for today's investor that they have to actually accept more volatility to have less risk. I've been watching and tying in these holiday movies with my kids. Was watching Home Alone the other night. Kevin goes down into the basement, as you might recall, and there's the furnace. It's loud, it's scary, it's making all sorts of noises, just like a bear market might. And he eventually just has to accept that's not going to change, but I'm not going to be afraid of it anymore. And he just tells the furnace to shut up. That's what I need you to do with respect to volatility, is remember, hey, you might be loud, you might be scary, but there's nothing fatal about that with respect to your portfolio, and move on. The second piece to this quick wrap up of year end of how to get our minds right as we launch into 2021 is this concept of buying the all-time highs. Matt, quick question. Do you find yourself an investor that chases the return? I know I'm loading this question up for you here, leading the witness. But hey, we all have these tendencies. Or do you find that buying low and buying the dogs that maybe tomorrow's winners is something that comes very naturally to you?
I have two answers. One is I'm a skeptic. So when a stock reaches my attention, because I'm not paying a lot of attention to it, I assume that it's already done what it's going to do price-wise, and I'm not going to get any special deals on it. And then my other thought is there's always another one. So I did the math once, and if I'd bought Amazon stock, instead of paying for Amazon Prime, I would have like $15,000 now. If I go back for like the 12, 15 years that I've been an Amazon Prime member. And that kind of bums me out. But I think also there's always another Amazon. Like there's that next Amazon coming. And if I can figure out what that is, then maybe I can get that one instead. And so I do hope that, you know, I'll get my opportunity at some point, which would be fun.
Ever optimistic is important.
Yeah.
Well, like I said, we're gonna go into depth on this great piece and attack this topic from many angles. But for today's purposes, some good news, bad news. We'll start with the bad. The bad news is for an investor, finding that perfect entry point, or even a really good entry point at the bottom, i.e., a price of which you would never be able to buy lower in the future. Your odds of doing that, just looking at the S&P 500, is about 5% historically. So little to no chance that the day you buy whatever stock or index fund or whatever the case may be, that there's never going to be a day in the future where you couldn't have bought it at a lower price. That's the bad news. The good news is that pressure then that you might feel of trying to find that moment is really not that necessary. The difference between finding that point and finding a point in which you bought when the stock market was more than 5% off of an all-time high only results in about a 1% difference in return. So yeah, that could compound to be some nice money over time, but it's not going to make or break your plan. And that's the most important thing. Again, kind of in that theme of risk and volatility, which is, yeah, avoiding volatility is nice, but what we've got to do is avoid risk, permanent loss of capital. What we've got to do is get that money to work, right? It's time in the market, not timing the market, that leads to success. And that's the real point. So we're going to wrap it up there. Hope you all having a wonderful holidays. Happy New Year to you all. I hope you'll check out the Weekly 10 commentary right below in the Weekly 10 email, where the team really talks about what they're looking forward to most in 2021. Spoiler alert, for so many of us, it's the chance to see you. We've missed you this year. We've missed the events. And we look forward to the chance to do those again very soon. With that, Matt, thanks for rolling with this today and for being a good sport to join on the call. And I look forward to seeing you in the new year as well.
Thanks.